Hi, I'm Jenny Brown, and a very warm welcome to our weekly buy-to-let mortgage market update. How are we all keeping? Hope everybody's doing well, and the lockdown and all that brings with it is not getting you down too much, and you are all winning at the homeschooling thing. If you are, you're doing far better than me. I seem to be failing miserably. But I hope everyone's okay. Now, in terms of our update this week, we've got quite a lot of news to report. And I want to start off, as usual, with lender changes. Now, you will remember that last week it was relatively quiet in terms of lender news, what with people returning from Christmas and the New Year break and things being a little bit slow to get going. But there have been some changes that I want to just talk to you about this week. So first of all, we've seen some new rates released from Paragon, which are for multi-units and HMOs. And these are for larger loans. So loans are between £350,000 and £1 million. Now, these rates are incredibly good. What is particularly good about them is they have flat arrangement fees and very low rates. So if you do want more information on these, please do give us a call. Now, Paragon are a lender who can lend to individuals and limited companies, and they have some fairly good pieces of lending policy. For example, no maximum properties in the background. But the thing that I think really sets them apart from their peers in this particular space of HMOs and multi-units is that they can consider properties of up to 20 bedrooms or 20 self-contained units. So if you factor in that if you've got a larger block of flats or a larger HMO, and you can get a very competitive 5-year fixed rate with a flat arrangement fee, and I should also add there's a free valuation with their products as well, it actually makes for a very good deal. So well done, Paragon. We've also seen fleet mortgages reduce their rates, and these are now starting from 3.19%. Now, Fleet are another lender who operate in that more specialist end of the market, so Fleet will lend to limited companies and individuals. For me, part of their proposition that is quite special is they're quite flexible in terms of the types of properties they will lend on. So they're very good at flats over commercial, ex-local authority flats, and also flats with deck access, which a lot of lenders aren't very keen on. Again, Fleet can also lend on multi-units and HMOs, and they don't have a maximum number of properties in the background. The other thing actually that I quite like about their offering is that the maximum age on application is 89 years old. So a really good broad lending approach to risk, but also some very competitive rates at the moment. Now, we've also seen in the last week the West Bromwich release a couple of new rates at 75% loan to value, which are proving to be incredibly popular with our clients. Particularly because these deals have a free valuation and again a flat arrangement fee of £1,999, and the rates start at 2.89%. Now, if you receive, or you're watching this video because you've come to us for our weekly mailing, if you check out my rate of the week, you'll see more details of the 5-year fixed rate there, which is proving to be so very popular with our clients. It's a really good option. Now, West Brom only lend to limited companies, so no lending to individuals, I'm afraid. They don't have a maximum number of properties in the background. You can be up to 80 years of age when you apply for a mortgage with these guys. And one of the things that they offer, which is quite unique in the specialist end of the market, is flexibility on overpayments. So you can overpay by up to £1,000 per month, which is really quite unique. So again, great news from West Bromwich. The last piece of repricing I just want to tell you guys about is from Foundation Home Loans. So they have made rate reductions across their range of between 0.05% and 0.2%. And they've particularly focused their pricing reduction on their more specialist tiered products, so their F2, F3 tiers and their HMO products. Now, F2 and F3 refers to the products that they have available for those people with imperfect credit files. So they have a kind of mainstream product set, which is for those people with pristine credit files, and they have secondary product sets available to those with less than pristine. And so what they've done is they've obviously looked at their product offering and realised that actually they're a little bit toppy on pricing there, so brought that down to be more in line with the market and make their offering more appealing to potential borrowers. The products themselves are very good. They have a varying range of fees starting at 1% of the loan amount, also flat fees of 1,495 depending on the product. They also have some remortgage products which have free valuations and £250 cashback. So really great offering from Foundation Home Loans. Now, Foundation are in the same space as Fleet, Paragon and West Bromwich, so limited company mortgages are fine. They'll also lend to individuals. They don't mind those with larger portfolios in the background. no minimum income requirement. So yeah, very much in that sector of the market, we're seeing a lot of rate movement at the moment, which is really, really encouraging. So just staying on with lenders for a moment, but a couple of pieces of lending policy change, which I want to share with you just because I think they are potentially indicative about how things are going to move in the future. So first of all, Santander have announced they're going to be restricting the maximum loan to value for homeowner applications to 60% for all self-employed borrowers. They haven't extended this to buy-to-let applications. And what I would say is we certainly haven't seen a rush of other lenders looking to do the same thing yet. But it's worth just talking about this in a bit more detail. So if you're self-employed and you have submitted your most recent tax return, which I have not, I'm definitely a 31st of January running around like a headless chicken panicking type person. But for those people who are more organised than me, and I'm sure most of you are, the tax return that you will have done essentially will provide information on your income up to April 2020. Now, that is 7 months ago, so really quite a long time, so 9 months ago, so a long time, in the past, and also a lot of water has gone under the bridge since then. If you look at where we were in April 2020, we were in the full throes of lockdown, the kind of impact on employment and work was really kind of starting to take a bite with things. And so from a lender's perspective, when they're assessing income from self-employed people, what they're doing is looking at something that is very historic. It's not current information. And I suspect that what's happened with Santander is they've really had to think about lending to self-employed people and have decided they're uncomfortable lending, particularly in the current environment, to those people where they're only able to really assess income, which is, so many months old now. Now, like I say, we haven't seen a rush of other lenders looking to follow suit, but when you do get a lender as large and prolific as Santander making such a large policy change, you can be very, very confident that other lenders will be immediately looking at their policy and just really reassessing whether they want to kind of follow suit or, maybe make a half measure to kind of keep in line with that, or whether actually they're just very comfortable carrying on as they are. So just one to watch. We'll keep reporting on that one going forwards. Now, another thing that has changed in the last week is that Precise Mortgages, and this because they're owned by one savings bank, also includes Kent Reliance, have said that from going forwards, any applications where an applicant is an EU citizen must now provide a valid permanent residence document or evidence that settled or pre-settled status has been granted under the EU settlement scheme. And this can be in the form of a letter from the Home Office confirming their settlement status or indeed a residence card. So just for your own information, settlement status is awarded to EU citizens that can evidence a minimum of 5 years continuous residence in the UK, whereas pre-settled status applies to those who have not resided in the UK for 5 years. And those awarded with pre-settled statuses can apply for settled status once the 5-year residence requirement can be met. So really just to keep in mind that for those people who are EU citizens who are looking to apply for mortgages going forwards, just know that this isn't going to be they aren't going to be the only lender who are asking for this. This is going to become a theme. So just make sure you've got your paperwork in order. Lastly, a bit of a blow from my perspective, Kent Reliance have changed their lending policy going forwards. And what's happening is that if you have a limited company, whereas Kent Reliance used to only take personal guarantees from directors and not shareholders, they're now going to be looking to take personal guarantees from shareholders too. And because there is a maximum of 4 applicants on an application form, there can be no more than 4 directors and or shareholders. And this really aligns them actually with most of the other lenders in the market. Most of them work on this basis or similar vein. And it's a bit of a shame actually, because quite often Kent Reliance have been very good at lending taking PGs from directors, which is, if we've got someone, for example, a shareholder who may have been overseas, for example, it hasn't really impacted things. But again, I suspect what's happened is they've had a look at their lending policy and realised they are kind of fairly standalone in their approach, and so they're looking to align themselves with the rest of the market. Now, on that note, the processed by lenders underwriting limited company mortgage applications and who they take personal guarantees from is really quite poignant. And I know a lot of our clients want to set up company structures where they have, kids owning a certain percentage, holding companies. So our SPV is owned by a holding company, owned by people. They like to have, a certain percentage of the company owned by trust. All of these things are not insurmountable when it comes to obtaining a mortgage if you have a more complex structure in the background. But it really is worth having a chat with us, first of all, just to understand if you do put one of these more complex structures in the background, in terms of the shareholding structure, how it's going to impact your ability to get mortgages, just so you aren't disappointed down the line. Negative interest rates seems to have reared its head again. So this was discussed back in 2020. And I think there was kind of a spark of interest as the banks were told to ready their systems to be able to deal with a negative interest rate situation, which really got people thinking actually negative interest rates really could be on the card. Now, I know there's been a lot of chat about this in the press. Indeed, I was listening to something on Radio 4 this morning talking about this, and I read a sort of article which I thought was quite interesting. So Silvano Tenreo, apologies if I got that pronunciation wrong, an external member of the Bank of England's Monetary Policy Committee, has said that negative interest rates could be good for economic growth in the UK and could aid its recovery from COVID-19. Now, during a speech yesterday, Silvana said that negative interest rates have worked effectively in other countries, with some of the evidence pointing towards more powerful effects. She said that the effects of negative rates should lead to higher consumption and investment and boost net exports and inflation. Now, the Bank of England is currently examining the feasibility of negative interest rates, and the MPC would then face a separate decision over whether they are the right tool to use during this current time to kind of try and bolster the economy. Now, if interest rates do go negative, what does that actually mean to you as a borrower? Now, the first thing is, if you are on a fixed mortgage rate, if rates go negative, it will not have any impact on the interest rate that you are paying because your rate is fixed and won't move. If you're on a variable rate, it will really depend on the kind of terms and conditions that sit around that rate. So if your mortgage is directly linked to Bank of England base rate and base rate goes down, your interest rate will follow proportionately. Whether that puts you into a negative situation or not would remain to be seen. It just depends on the numbers of your specific deal. However, if you have a variable rate which is linked to the lender's in-house standard variable rate or floating rate, it will really depend what the lender does with their standard variable rate in terms of whether they reduce it and then the margin that you have as to how that shakes out for you in terms of the interest rate you end up on. What you will not see is lenders offering going forward new mortgage rates which are based on a negative interest rate scenario. Okay, so for anyone who's sort of thinking that's great, I'll be able to take a mortgage and someone will actually pay me for having it, that isn't going to be the case. It's not really how it works, but it could mean that actually some people will stand to benefit, particularly on existing arrangements, if interest rates do come down or even go negative. So we'll keep you posted on that as we hear further news. Okay, moving on to property news now. So the government have announced that millions of leaseholders will be given the right to extend their leases by a maximum term of 990 years at zero ground rent. So under the current rules, leaseholders of houses can extend their lease once for 50 years with a ground rent. And this compares to leaseholders of flats who can extend as often as they wish at zero peppercorn ground rent for 90 years. So the changes announced meant that both houses and flat leaseholders could be able to extend their lease to a new 990-year arrangement with ground rent at zero. Now, the changes will mean that any leaseholder who chooses to extend their lease on their home will no longer pay any ground rent to the freeholder. Now, for some leaseholders, these changes could actually save them tens of thousands of pounds. A cap will also be introduced on ground rent payable when a leaseholder chooses to either extend the lease or indeed become the freeholder. And an online calculator will be introduced to make it simpler for leaseholders to find out how much it will cost them to buy their freehold or extend their lease. So there's really work afoot on the Leasehold Reform Act going forwards, and we'll keep reporting on news as we hear it, but some really good news there for those people who are looking to extend leases. And now some housing market news for you. So London was noted as recording the greatest number of property purchases across the UK in 2020, according to Really Moving. Their data shows that the capital saw 13.7% of all completions, followed by Leeds at 1.7% and Birmingham at 1.6%. Now, between July and December 2020, the proportion of first-time buyers in the market fell by 12% compared to the same period last year. Now, interestingly, just on that point, in terms of first-time buyers, there's been a sort of a kind of push or blame, as it were, on the absence or lack of 90% loan-to-value mortgages available, which has precluded first-time buyers from the market in the back of second half of 2020. And actually what we've seen in the last week is a whole swathe of lenders coming back into the 90% market, which should really help to help our first-time buyers start getting back on the property ladder again. So over 2020, first-time buyers made up 51% of all buyers in the market, compared to 56% in 2019. So again, the percentage of first-time buyers has dropped. While 16% of first-time buyers opted for a new build home over an older property, almost half of those, 46%, used the Help to Buy equity loan, enabling them to buy with a deposit of just 5%. Now, the report goes on to say that the average house price in England and Wales increased from £293,819 in January 2020 to £352,000 in December 2020. However, Really Moving are predicting that house prices will fall by 1.2% in January and 2.5% in February 2021. So just some housing news for you there. And actually, just on that note, I just want to share a little story. So one of my buy-to-let properties, the tenant has just served notice on and they're going to be vacating in March. So I phoned my letting agent up and said, how's the market where this particular property is? And we're in Sevenoaks in Kent. And they said to me that they cannot believe how busy it's been. There is an absolutely huge demand from renters looking to move properties at the moment. Indeed, in the first week back after Christmas, they took 70 new inquiries, which, for those of you who aren't familiar with Sevenoaks, it's not a big town, it's not a hugely populated area, so 70 would be a lot. And what they were saying to me was that really the inquiries they're getting through are from people who are looking to relocate, particularly from more urban areas out to the country to, again, just kind of, give themselves some more green space. But I think really for me, what was really encouraging was just the news that actually there is a strong demand for rental properties. In my area, I'm not going to talk for every other area, but firsthand I'm experiencing this. And actually they're looking at increasing the rent by around 8% on the property as well, which is really good news. So lots and lots of news this week, and I'm sure things are going to carry on being fairly busy on the news front as we really kind of get into January. Things are always a little bit slow to get going after Christmas, but I feel that momentum is really starting to build now. So obviously we'll try and keep you posted and abreast of things as much as possible. However, if you do want to really keep abreast of information and you're reading this or watching this video, having not received the link for it from our newsletter, it's worth signing up to our investor update. If you go onto our website, you'll be able to do that. We send it to you once a week as an email, and it covers off really good market news, as well as giving you blogs and case studies and stuff. So really interesting reading. So for now, that's us for this week. Do give us a call if you have any questions, 0345 345 6788. I hope you're all doing okay. It's not the greatest time at the moment. I'm just sitting here at the moment, sort of glancing to the window, and it's grey and it's drizzling. So, we will get there, I'm sure. Someone mentioned the other day, to me, that actually they're expecting us to be locked down until the end of March. So I hope they were wrong. Anyway, look after yourselves, take care, and I'll see you next time.